On the 6th of August, 2026, a wave of nearly 1 billion SpaceX shares became eligible for sale on the open market. It was the first time since the company's NASDAQ debut less than 2 months earlier that this much stock could trade freely. This was the single largest lockup expiration in the history of American capital markets. Roughly 911.5 million shares, worth somewhere north of $116 billion, hit the market at once. It arrived at a moment when the stock was already down almost 50% from its all-time intraday high. SpaceX had priced its IPO at $135 a share on June 11, 2026. It began trading the next morning to a wave of euphoria that briefly pushed shares to an intraday peak of $225.64. That valued the company north of $2.6 trillion. For a few dizzying weeks, it was one of the most valuable companies on Earth. By the last week of July, that same stock had fallen below its own IPO price, closing under $132. It then slid further toward $112 as the company approached its very first quarterly earnings report. That report was scheduled for August 4th. As a newly public entity, Elon Musk briefly became the world's first trillionaire on the back of this rally. He then watched his net worth shrink by more than a quarter in a matter of weeks. It slid from over $1 trillion to somewhere around $786 billion, according to Forbes. And buried inside SpaceX's own IPO prospectus, the mechanics of exactly why this was coming had been sitting in plain sight. Only about 5% of SpaceX's total shares were actually released for public trading at the IPO. 95% remained locked up, deliberately restricted. That created an artificial scarcity that inflated the stock's early price far beyond what genuine trading volume could support. That scarcity was never going to last. And now, right as the euphoria was already fading, the floodgates were about to open. To understand why this matters so much, you need to understand what SpaceX actually is, and more importantly, what it claims to be worth. On paper, the sprawling empire built by Elon Musk consists of 3 very different businesses stitched under a single stock ticker: Space, which designs, builds, and launches reusable rockets; Connectivity, the Starlink satellite internet division; and, added only recently, an AI segment built around Musk's chatbot Grok, the social platform X, and a portfolio of AI computing infrastructure. 2 of those 3 segments tell a genuinely compelling story. Starlink generated $11.4 billion of revenue and $4.4 billion of operating income in 2025 alone, with operating income more than doubling year over year. And it added another $3.3 billion of revenue in the first quarter of 2026. That's a real functioning internet service provider, with over 10 million paying customers worldwide, delivering broadband from low Earth orbit to consumers, businesses, and governments who otherwise have no good alternative. The rocket launch business, meanwhile, remains dominant in raw capacity, responsible for roughly 90% of America's space launch activity. But dominance in a niche industry does not automatically translate into trillion-dollar valuations, because the actual dollar revenue generated by launch services is, according to independent analysis, roughly comparable in scale to the annual revenue of OnlyFans. That comparison sounds almost like a joke until you sit with it. An entire fleet of reusable orbital rockets, the most advanced launch technology on the planet, generating revenue in the same neighborhood as a subscription content platform. Then there's the AI segment, the piece of the valuation story that has drawn by far the most scrutiny, and the one this documentary is really about. Grok, the large language model developed by Musk's xAI and folded into SpaceX's corporate structure through a merger, lost $6.4 billion from operations in 2025 and posted an additional $2.5 billion operating loss in just the first quarter of 2026. The space segment itself lost money across both periods as well. Only Starlink was actually profitable. And yet, the AI division was the one carrying the most weight in the story SpaceX and Musk were telling investors, the narrative that justified a valuation that, even at its lows, still sat around $1.7 trillion. The core problem is straightforward. Nobody actually uses Grok. Not because it's incapable, its benchmark scores are broadly comparable to other frontier models, but because it has no meaningful differentiator in a field already dominated by established players. The United States federal government maintains active contracts with 3 major AI providers: Anthropic, OpenAI, and xAI's Grok, giving every federal employee equal access to all 3. Anthropic ranks first in actual usage. OpenAI ranks second. Google gets brought in when the first 2 can't solve a problem. Grok, despite having 0 barrier to entry for any government worker who wants to use it, sits essentially unused. When the people who have unrestricted, cost-free access to a product still refuse to use it, that is about as clear a signal as markets ever get about genuine product-market fit, or the lack of it. Analysts have separately noted that the roughly $100 range SpaceX shares were trading in during late July effectively implied that xAI, the AI arm merged into the company, was being valued at close to zero. The Grok merger, which was supposed to be a major value creation event, did essentially nothing to move the stock. It simply added another loss-generating segment onto a balance sheet that already had two. The financial engineering underlying the June IPO deserves particular attention because it explains almost everything that happened afterward. Restricting 95% of shares from trading was not a standard lockup structure. It was a deliberate scarcity mechanism designed to manufacture a high opening valuation with minimal actual float. SpaceX took what's sometimes called a staggered unlock approach, specifically to avoid a single overwhelming supply shock, releasing shares in tranches rather than all 180 days later in one lump, as most IPOs do. The plan called for 20% of eligible locked shares, up to 901.5 million of them, to become tradable 2 full trading days after SpaceX's first ever quarterly earnings report. A bonus 10% tranche was designed to unlock early only if the stock closed at least 30% above its IPO price, meaning above $175.50 for 5 of the 10 trading days heading into that earnings report. SpaceX never came close to hitting that threshold in the run-up to August, meaning the bonus tranche stayed locked, but the base 20% unlock proceeded regardless. Beyond that first release, additional 7% tranches were scheduled to unlock roughly every 2 to 3 weeks through late September and into October, an accelerating drip of new supply hitting a market that had already shown repeatedly that demand at these prices was thin. Elon Musk's own personal stake of roughly 6.4 billion shares remained separately locked until June 2027, meaning his own holdings weren't adding to the pressure directly, but that offered little comfort to the tens of thousands of employees and early investors who suddenly found themselves able to sell for the first time. That's where the human dimension of this story becomes impossible to ignore. Musk deliberately structured the IPO to allocate an unusually large share, roughly 30%, to retail investors, a proportion far above what's typical for offerings of this size. Institutional IPOs typically keep retail allocation in the single digits or low teens, precisely because retail investors are more prone to buying at the top of hype cycles and panic selling into declines. SpaceX inverted that ratio deliberately. The result is that a disproportionate share of the roughly $1 trillion in paper losses since the June peak has landed directly on ordinary individual investors, the retail buyers who piled in during the initial euphoria, watched the stock nearly double intraday to $225, and are now watching it hover in the low hundreds, some publicly describing losses in the tens of thousands, even hundred. Short sellers, meanwhile, have been circling aggressively, with bearish positioning reportedly reaching roughly a third of the stock's available public float in recent weeks, a remarkably high concentration for a stock this large. Musk responded to the slide, not with reassurance grounded in fundamentals, but with characteristically grandiose predictions, insisting the company would eventually be worth more than the entire planet Earth, and sparring publicly on social media with critics and short sellers over the scarcity of resources on Earth versus the near infinite resources theoretically available in space. Whatever one makes of the long-term vision, none of it addressed the immediate mechanical reality. A wall of newly tradable shares was arriving into a stock already down 42% from its peak, with weak first quarter results looming and no clear catalyst to absorb the new supply. There's also a subtler warning sign embedded in Musk's own personal finances, one that echoes a pattern seen elsewhere in the AI infrastructure boom. Musk has reportedly used roughly a third of his stake in Tesla as collateral for personal margin loans, borrowing against the value of those shares rather than selling them outright to fund various obligations. Margin loans work in a simple, unforgiving way. If the value of the pledged stock falls far enough, the borrower must either post additional collateral, come up with cash, or face a forced sale by the lender. Analysts have pointed to a danger zone around $290 for Tesla shares, a level at which Musk could be compelled to pledge more stock or raise cash, potentially by selling shares in either Tesla or SpaceX, precisely the kind of forced selling that can cascade into a broader price decline. As Tesla shares themselves came under pressure following a disastrous earnings report, sliding toward the $300 range, that danger zone stopped being a hypothetical and started looking uncomfortably close. It's the same structural fragility playing out elsewhere in the AI economy. Enormous personal wealth built on paper valuations, quietly leveraged against loans that only remain safe as long as the underlying stock keeps climbing. But as dramatic as SpaceX's collapse in value has been, it may not even be the clearest signal that the broader artificial intelligence investment boom is beginning to buckle. That distinction arguably belongs to a set of quieter, far less publicized developments involving Oracle, Anthropic, and OpenAI, developments that reveal just how thin the confidence underpinning these companies' financing has actually become. In Wisconsin, state utility regulators upheld a rule requiring Oracle to post more than $7 billion in collateral, either as cash or letter of credit, before it can secure electricity for a nearly 1 gigawatt AI data center campus it's building in Port Washington, alongside developer Vantage and ultimately for OpenAI. The rule exists specifically to protect ordinary electricity ratepayers from being left holding the bill if a massive data center project stalls or gets abandoned partway through construction, and it applies automatically to any developer whose credit rating falls below A-. Oracle's rating, at the time, set 2 full notches below that threshold. Oracle pushed back hard, filing suit against the state's Public Service Commission and offering to post only 10% of the required amount, roughly $700 million, backed by a parent company guarantee instead. Wisconsin regulators refused to budge. Read plainly, a state utility regulator looked at one of the largest, most established enterprise technology companies in America and effectively said, "We don't trust your credit enough to let local ratepayers carry the risk if this project doesn't work out." That same distrust shows up again, in a different form, in how Anthropic has had to finance its own infrastructure build-out. When chipmaker AMD agreed to invest up to $5 billion in Anthropic and sell it tens of billions of dollars worth of AI servers, including access to up to 2 gigawatts of its newest Instinct MI450 chips, the headline framing sounded like a routine strategic partnership. Buried further into the reporting was something more telling. AMD was separately in talks to provide a financial backstop for Anthropic's future data center leases, effectively agreeing to underwrite Anthropic's ability to commit to long-term capacity the way a co-signer backs a loan for someone without sufficient credit history of their own. Google has reportedly done something similar, agreeing to backstop portions of Anthropic's data center lease obligations to help secure access to its own TPU chips. In one case, backing a Texas facility exceeding $5 billion in construction financing. This is not equity investment, and it's not a straightforward loan. It's a structural admission that data center owners and lenders don't yet trust Anthropic's own balance sheet enough to extend financing on its name alone, so a better capitalized partner has to stand behind it. And then there's the number that dwarfs almost everything else in this entire story. NVIDIA has been in talks to provide OpenAI with a financial backstop worth roughly $250 billion, guaranteeing lease and construction financing for a proposed 10-gigawatt data center campus being developed by SoftBank's SB Energy subsidiary on a decommissioned uranium enrichment site in Piketon, Ohio. That $250 billion figure covers only the lease and construction. It doesn't include the chips themselves, which could add another $350 billion, pushing the full cost of a single campus past $500 billion, making it, by cost, the largest data center project ever proposed. The reason the guarantee exists at all is simple. OpenAI does not hold an investment-grade credit rating of its own, so it cannot borrow at reasonable terms on its own name. By having NVIDIA stand behind the debt instead, lenders get comfortable financing a project for a customer, OpenAI, that would otherwise struggle to raise the capital independently. It's worth sitting with the circularity of that arrangement for a moment. NVIDIA manufactures the chips. NVIDIA is now, in talks at least, financing the leases for the buildings that will house those chips for a customer, OpenAI, whose primary product is built almost entirely on NVIDIA's hardware. If OpenAI ever stumbles on payments, NVIDIA isn't just losing a customer, it's potentially on the hook for the debt behind an entire data center campus. NVIDIA previously pledged up to $100 billion directly into OpenAI in 2025. Though that specific commitment never fully materialized, it did contribute $30 billion to a record funding round OpenAI closed in early 2026, with NVIDIA's own chief executive suggesting publicly that it might be the company's last direct investment in OpenAI before any eventual public listing. Every one of these arrangements, Oracle's forced collateral posting in Wisconsin, AMD backstopping Anthropic's leases, Google backstopping Anthropic's TPU obligations, NVIDIA potentially backstopping $250 billion of OpenAI's real estate commitments, tells the same underlying story from a slightly different angle. The companies building the physical infrastructure for the artificial intelligence boom increasingly cannot secure financing on their own creditworthiness. They need co-signers, they need parent guarantees, they need utility regulators forced to demand billions in collateral specifically, because state officials no longer trust that a project, once started, will actually be finished and paid for on the terms originally promised. None of these are equity purchases in the traditional sense, and none of them are simple loans either. They occupy a strange middle ground, contingent liabilities that don't show up cleanly on balance sheets the way straightforward debt does, but that carry very real financial exposure if the underlying company can't make good on its obligations. Set against that backdrop, SpaceX's post-IPO collapse and the accompanying evaporation of any real value assigned to its AI division stop looking like an isolated Elon Musk story and start looking like one visible symptom of a much larger pattern. A company built its valuation on the promise that artificial intelligence, robotics, and space infrastructure would each individually justify multi-trillion-dollar addressable markets. Investors, initially, were willing to accept that promise almost entirely on faith, aided by an IPO structure deliberately engineered to restrict supply and inflate the appearance of demand. But faith is a fragile foundation for a balance sheet, and the moment structural mechanics, share unlocks, disappointing earnings, credit downgrades, forced collateral postings start exposing the gap between the story being told and the cash actually being generated, that faith erodes fast. SpaceX's Starlink business remains genuinely valuable, a real, growing, profitable telecommunications company. But the AI segment riding alongside it inside the same stock ticker has, by the market's own pricing, been assigned something close to zero additional value, even as it continues to burn billions of dollars a quarter. Grok exists in a crowded field where government employees with zero switching cost still choose not to use it, where benchmark parity with competitors hasn't translated into adoption, and where the merger meant to combine it with SpaceX's broader ambitions did nothing measurable to the stock price on the day it was announced. The deeper lesson sitting underneath all of this isn't really about rockets or satellites or chatbots. It's about what happens when enormous sums of capital get committed to infrastructure built on the assumption that demand, revenue, and trust will simply materialize to match the scale of the spending. Wisconsin's utility regulator wasn't willing to make that assumption. AMD and Google weren't willing to let Anthropic borrow purely on its own name. NVIDIA is reportedly willing to stake $250 billion of its own creditworthiness, specifically because OpenAI, on its own, could not raise that financing independently. And retail investors who piled into SpaceX at $135, $180, even $225 a share are now watching those same structural realities play out in slow motion, as billions of dollars in newly unlocked shares meet a market that has started asking, with increasing insistence, what exactly all of this AI-adjacent spending has actually produced. The rockets still fly, the satellites still connect millions of people to the internet from orbit. But the trillion-dollar story that was supposed to justify everything else riding alongside them is, for the first time, being forced to answer a question it has spent years avoiding. Not whether the technology works, but whether anyone is actually willing to pay for it at the scale the valuations demand.